please welcome Wayne Hillier and Steve Tsonev. Come on up, guys. And even Adrian was mentioning earlier that numbers are one that you need good clarity on.
Thanks so much, guys. What's this? Oh, thanks so much. Appreciate it. This is a really cool space. I haven't been to a Mogul Mastermind. I admit, I apologize. I haven't been to a Mogul Mastermind in quite some time, and this space is amazing. And it's so incredibly cool to see that Mogul Mastermind has been around for so long and this many years and continuing to keep providing so much value. So I'm really grateful to be here and presenting in front of you guys with Steve. I just want to do a round of applause for Mogul for putting on an amazing event. I think it's definitely worth it. Really, really cool. Really happy to see this. So today we're going to be talking about bookkeeping, taxes, accounting, and what time is it? 8:10, 8:15? I'm going to see if we can try and keep you guys awake. I'm not going to lie. Steve does not like when I say this.
I love the topic.
Yeah, well, he loves it. He could talk about it until midnight, and even after you guys fall asleep. It can be a little dry sometimes. I'm going to see if I can, keep things stimulating, keep you guys excited about it. I know there's always like one. I'll ask a crowd like, "Who's excited about accounting?" There's always one nerd in the back that just absolutely loves it and they're excited about it. So good for you guys for coming out again on a 33-degree Celsius night, to learn about accounting and bookkeeping. I don't know. Anyways. So my name is Wayne Hillier, for those of you guys that don't know me. I'm head of business development at Finngo Bookkeeping Tax. One of the founding partners, and this is my other business partner, the managing partner, Steve Tsonev. He's the guy that runs the show. He's the guy that knows everything. I'm just honestly up here to keep you guys awake.
Yeah.
Plain and simple.
Thanks.
That's about it, right? So
yeah,
I think
we need that. We need that for sure.
I'm very excited about this.
We do have a little bit of swag to give away, and we have some questions, so hopefully everyone can stay away tonight.
Yeah, no, you just
take it away,
man.
All right, let's get started. Today, we are going to start talking about your mindset. That would be our foundation for everything else that we will cover the rest of the night. When most people get into real estate, they think about properties, not about profit systems. They're focused on the deal, not on the machine. But over time, the people who build real estate wealth are the ones who treat the real estate like a business, not just like an investment. So, by quick show of hands, who here has ever felt that their real estate portfolio is running them instead of the other way around? Yeah, exactly.
Be honest.
Let's talk about being reactive versus proactive. A reactive investor would be one who would only deal with bookkeeping at tax time. They don't know their numbers until something goes wrong. They scramble when the bank asks for financial statements or CRA sends a letter. They would be waiting until they have time to organize their receipts. And often they would leave tax planning until it's a little too late. On the other hand, a proactive investor, someone that acts as a business owner, would be reviewing the performance monthly or at least quarterly. They would know their KPIs, your cash flow, your ROI, your equity, tax liability. Those are all important things to know. They would also have systems or a team in place to handle administration because we all suck at it. Proactively, they would be asking, how can I reduce tax this year? And usually, they would use real estate to build a generational wealth on purpose and not just by accident. The mindset shift here is simple. Stop managing your properties and start managing a business. Your real estate portfolio is your company. And like any company, it does need structure, it needs systems, and it needs leadership. If you want consistent growth, financing opportunities, reduced tax risk, you need to think like the CEO of your business. That's the thread we'll carry through the rest of the night. That would include your bookkeeping, tax planning, and corporations. They're not just administration tasks. They are strategic opportunities. So my favorite starting point is bookkeeping, because that is really the foundation of your business. Everybody needs to start with a clean set of books. This isn't just about being good with spreadsheets. It's about building financial clarity, getting financing, and being prepared for tax time year-round. Think of your bookkeeping system like the scaffold of a building or its foundations. If it's shaky, everything else becomes risky. Taxes, audits, even your ability to grow. So let's talk about a few things that you should be tracking. There are 5 core things that I think you should be tracking regardless of whether you own 1 or 10 properties. And it all starts with income. We need to understand what type of income you have. Is it long-term rental income? Is it short-term or Airbnb income? Is it side income from garage or laundry? Anything else that you may have? We would then move into tracking your expenses. That would be all of your regular expenses that you would deal with every year at tax time. Your utilities, your property taxes, maintenance, management fees, interest on the mortgage. That's something that we deal with every single client on an annual basis. But also, we have your capital improvements. That is what Adrian mentioned earlier, CapEx. Capital improvements would be renovations that increase the value, and they are treated differently for tax purposes. So we will go into that further a little bit later, but it is something you want to be tracking early on. Next would be mileage and travel, especially for site visits, project management, viewing properties. I think a lot of investors lack in that department. Mileage and tracking is a big expense for many of you, so let's find a way to track it easily.
I just want to see a show of hands. How many of you guys actually track your mileage? Because that's probably one of the biggest expenses, that a lot of people are, oh wow, look at you.
No, but I used to use Google Maps.
Yeah?
And because it would just keep track of it, that used to be an option. It seems like it doesn't function the same way anymore.
Not anymore, but there are some other tools.
Because it was super easy to go back and be like, trip.
I'm terrible. Like, terrible. Gabby, at the end of the year, every year, she's always like, you're not using, so we have a little book. She's like, you're not using the book. So what she does, she goes back into our Google Calendar and sees all the places that I went to, or sees the meals that I had, and then she like cross-references everything, and then she puts it together. Then she goes in Google Maps and like maps out the distance and stuff. It's an absolute
But that's still a good way to have something, and it's much better to have something than to have nothing.
You don't want to leave any money on the table. That's the whole point about
Exactly.
this, right? Because that's a huge deduction every year for a lot of real estate investors and business owners.
Your receipts and your contracts. Keep digital copies in case CRA audits or just for your due diligence. Having a contract and something that you can go back to and review and reference in an easy method, an easy way, can go a long way. If you track all of these things consistently, you won't just be prepared. You'll also spot inefficiencies early and make smarter decisions faster. Maybe like Wayne moving in from paper recording to something digital.
It's, you know what, like even being, the founder of Finngo Bookkeeping Tax, I'm still like, it's kind of like the contractor, you know what I mean? The contractor that, that can go and do all the work at somebody's house, but then they have baseboards just like lying up against the wall that haven't been pinned in yet. It's pretty bad. It is tough. All this is really tough. This is, we're going to be going through a lot of other expenses and other things that we should be doing, but it's, at the end of the day, what we're going to be sharing with you guys is that like you don't necessarily need to know all this stuff. You don't necessarily need to do all this stuff either. If you get the right team, you get the right professionals that can kind of take care of this stuff for you. There's lots of services out there, right? And they can help you implement this stuff to make sure you're getting the most deductions.
And some tools that we're going to cover.
You lost your mic, though, buddy.
Oh.
Here, we'll play. You do this, I'll do that.
Okay. And some tools like apps and stuff that we're going to cover in a little bit. So let's go over some common investor pitfalls that I see. My favorite, everything hits the same credit card. Personal and business expenses get muddled. That is very common. We want to avoid it when we can. It's a big, big no-no.
Is there anything more specific that you want to elaborate on that? Like, if you had one rental property, is that okay? One rental property in your personal name, no joint ventures.
Let's say this. If you have a credit card that you use for personal expenses, and you would like to hire someone to go through and do the bookkeeping for the year, how much do you think you'll need to pay me to do it if your credit card statement had 7 pages of transactions, and out of those, only a handful were for your rental, compared to if you had a card that only had 1 page for each month?
True.
And then
True.
I could just quickly go through and know, okay, all these are actually rental expenses. So the answer is, do something that makes your life easy.
Right.
If you can track all these receipts, and we can just cross-check them and find them in the bank statement, easy peasy, no problem. However, if you're like most other investors and it's likely you're going to lose the receipt or you're going to forget about that pre-authorized charge that you have, probably having a dedicated card would be a great way to handle it.
Yeah, and then obviously things can get a lot more complicated as you start, like I said, adding in joint venture partners, corporations,
Absolutely.
all those other things.
Yep.
It really is. That's okay. Very subtle, Nico, very subtle. Just keep cutting me off.
Number 2, no monthly reconciliations. I'll sort it out at tax time is usually what I hear, but that guarantees errors. If it's been 18 months, or close to at least 18 months since that transaction occurred, and I'm asking, hey, what did you spend this, $350 at Best Buy for? How are you going to remember? It's much, much better if you do it at smaller chunks more frequently and incrementally, so that way it saves you time. It feels more relaxed when tax time comes and you don't have to think about what happened a year ago.
Like those Home Depot receipts that say like ½ -3 -4 BRT, and you're like, what is a ½ BRT?
There are some really interesting things that I've seen on there.
Yeah.
Number 3 would be missing receipts. So I have a question for the room. Is a receipt required for you to be able to deduct that expense on your taxes?
Don't be shy, come on,
Yes?
louder.
Okay. Yeah, so go ahead.
If it's on your credit card, is that sufficient?
Great question. So let me ask you this. How many of you have purchased anything for your rentals from Facebook Marketplace? Do you get a receipt from Facebook Marketplace? No. So the answer is this. You can claim any reasonable expense that you incurred as long as you have a supporting document. It doesn't have to be a receipt, but perhaps taking a screenshot of the ad and the email transfer that you have would make it eligible. I also want you to think, in a year, you probably have 1,000 transactions that happen. If out of those 1,000 transactions, 800 of them have receipts and only 200 don't have, or they have some kind of secondary type of backup, like a screenshot or an email transfer or just a statement from your credit card, most likely that is going to pass and it's going to be just fine. But what if it was the other way around? And out of your 1,000 transactions, you had only receipts for 200 and nothing for 800 of them. At that point, you will get a lot more pushback from the government.
Right.
Okay? Renovations being treated as a repair. Misclassifications can cost you an audit or a refinancing opportunity. At our firm, I've seen many clients miss on thousands of dollars or create unnecessary audit risk just because they're misclassifying things or not telling us how or what the expense was for or how exactly they would categorize it or why they categorize it that way. It is good to get a second pair of eyes, particularly when it goes to your repairs and maintenance. There might be something that you spend money on and you think that it is not expensible, but we might be creative and find a way to do that. And I will give you an example on that a little bit later on. Now, the good news is you don't need to be a tech wizard. You just need a system. And I think Adrian talked about systems today.
Yeah.
And here I have an example of a folder structure that you can create for yourself.
Feel free to take a picture of this. Oh, I already see one person taking a picture.
You could set up a folder called My Real Estate Business, and then you could break it down starting with the year, and inside each year you could have the properties and information about the receipts, any statements, any lease agreements. You might not like the system. You might prefer one where you have the property as the first hierarchy and then the year inside of it, and that's okay. But having anything is much better than having nothing, and everything living in your email inbox. I would say maybe block time once per month, 15 to 30 minutes, upload all your receipts, review your income, reconcile your statements. Even better, delegate it to a bookkeeper like myself. The key is to stay consistent. If you stay consistent, you're gonna make a path forward, you're gonna move forward.
Can we do an exercise right now?
Yes.
Okay, we're gonna do an exercise right now, because you just said everyone should block 15 to 30 minutes in their calendar every month. Maybe all of us should pull out our phones right now and pull up our Google calendars and actually put it in there and then set it as consecutive for the next 12 months. And let's see if everybody actually does it.
That's
Seriously,
all
if
it
you
really
don't-
takes.
That's like, if I don't put it in my calendar, I'm never gonna do it. Now, by the way, I don't take care of any bookkeeping or taxes. It's my wife and my bookkeeper take care of it. I don't know anything about it. I have the right people on my team to take care of that kind of stuff. But I'm a real stickler with my wife, and she's not here, so I can talk poorly about her.
I'll tell.
But we make sure stuff is in the calendar, because if it doesn't go in the calendar, it's never going to get done. And I don't know how many properties each and every one of you guys has. Some of you guys have more than others, but when you got one property, it's okay, it's easy. Like, you can find those 15, 30 minutes. Once you start getting more properties, it's not that it becomes more work. It's about the same amount of work. It's still 15, 30 minutes. The problem is that you are more busy, and then you take up more of your time doing other stuff like raising capital, getting joint venture partners, finding deals, that type of stuff, right?
Going to events like this one.
Going to events, renovations and stuff, and you start coming up with excuses that you think that you're being productive and making money, but you're actually not doing the things you're supposed to be doing, which is the 15 minutes every month to do this. And then what ends up happening is you come with your giant shoebox at the end of the year, and you're like, here, Steve, can you fix this?
I know.
Right? So I highly recommend it. I know it sounds silly, and I know it's like this isn't like to be funny or something like that. Legit, put it in your calendar right now. Set it up every month, same day, right? Have that your bookkeeping day.
Exactly.
Like,
And there will come a point where you just feel like it's time where you could delegate that, and that is perfectly fine. But early on, you could start with just 15 to 30 minutes, and I think that's a great start for everyone.
Yeah.
I want to talk about some tools. I think the first tool is going to be, where do we track all of this? And that would start with our bookkeeping software, what we call a ledger software, something that can generate an income statement for us. The most common and the industry standard out there is QuickBooks, and QuickBooks Online, because they've already discontinued all of the desktop versions of it. QuickBooks Online would be a great starting point once you have more than 2 properties. There are other ones out there. For example, Xero is a very common one. Wave accounting for smaller portfolios could work. And lately, I've been seeing the introduction of Zoho Books. It is a newer platform in Canada, so don't trust it 100%, but it is available, and you could potentially be using that. Then we're going to move to receipt apps. Most common that we use at Finngo is Dext. Dext Receipts, it's literally the best platform out there. It also allows you to track your mileage through it. Dext would be D-E-X-T. I would recommend, if you're looking to purchase any one of these softwares, talk to an accounting professional if they have wholesale pricing for you. Because I think the retail prices are a little ridiculous out there for software. We get some pretty steep discounts when we buy in bulk through those platforms. But Dext Receipts would be something that we are currently transitioning all of our rental bookkeeping clients to. Literally today, I just recorded a video walking through how to use it, and we will be rolling that out. It's a platform that recently bought out by a much larger firm, and they've been investing a lot into it. So it is really a great one.
And again, just to summarize, what exactly is DEX? Maybe someone was just like, oh, what? What is it, DXT? What? Like, what exactly does it do, and why do they need it?
What DEX does is it helps you keep track of your documents. Think of it as a digital filing cabinet, something a little more sophisticated than a Google Drive or Microsoft OneDrive or something like that. It usually, any one of these apps would synchronize with your accounting software. So they would synchronize with QuickBooks, with Xero, with Wave. I'm not sure about Wave, but Sage, anything like that. And it will also allow you to collaborate and share with your accounting professional. When you prepare anything indexed and you post it to your books, a photo of that receipt gets attached to each one of the transactions. And your ledger software like QuickBooks has a button that says export for audit, and we can literally export everything in one click and give it to CRA to review.
Just going back to what you said before, proactive, not reactive.
Exactly.
Being proactive, setting up these systems ahead of time.
There is an alternative to DEX. That would be HubDoc. It is a platform that was created by Xero, I believe. It is not one that we personally use at Finngo, but if somebody out there is looking for an alternative, HubDoc could potentially be one. And then, like I mentioned to you, even just uploading to Google Drive. It could be much better to do that than just store everything in a shoebox. For any one of you that have a smartphone, which should probably be everyone in this room, if you have the Google Drive app, in the bottom right corner, there's a big plus button, like in many colors that Google has. And that one allows you to upload like a photo or anything like that from your phone. But right above it, there is a little square circle. And when you click that, it opens up a screen where it's going to recognize the four corners of the page that you're trying to scan. And it will just take a proper scan for you and upload it to Google Drive. It's very simple to use and free for most of you out there, at least 5 gigabytes, which I think should be plenty. So the next thing I'd like to talk about is spreadsheets. They are acceptable earlier on, but structure is everything. If you have more than one properties, you definitely want to categorize things by location. And if you're getting into 5+ properties, you probably need to move away. It only allows you to track income and expenses, so your profits for the property, but it does not allow you to track balance sheet items. So that would be the value of your asset, the liability for your mortgage, the investment that your joint venture partners provided for that building, any repayments you have made to that. So it is acceptable early on, but later on, probably not.
And you know what? Be proactive. I'm just gonna go back to that whole being proactive thing. You know, when you got one property, a spreadsheet seems like enough. The rent's coming in, the mortgage is going out, property tax going out, insurance going out, condo fees going out, bookkeeping and monthly bookkeeping costs going out. But like, it's pretty simple. Like anybody who, you know, learned how to use Excel back in grade 9, you know, they could figure it out. But again, as you scale up, I promise you, you will regret it if you don't set up these systems ahead of time, because you're gonna have so much more work going back and undoing all of that afterwards. So, but spreadsheets can work, you know, just gonna get started. If you find a really good deal, like Adrian calls you up and he's like, I got this amazing deal and we gotta close on it in the next 24 hours, and you're like, okay, get it done, use a spreadsheet, whatever. But set aside some time, like I said, put it in your calendar, 15, 30 minutes every month to go and allocate that time towards getting your bookkeeping in order. I think you have like a spider on you. Let me get that, buddy. There you go. Oh! Sorry, buddy.
It's okay.
Will you,
I think we
oh, there you go. Well, I'll take care of that. Or you continue. I'll take care of your lapel.
So, bookkeeping isn't just about the past. It's how you keep score and plan the future. Once that's in place, we can move on to structuring your business with the right legal entity and then applying the right tax strategies. So, everyone's favorite topic, corporations.
All right. What's going on here?
Thank you.
Yeah, you're
To my assistant. This is one of the top questions I get from investors. Should I incorporate? And the truth is, like everything else in life, it depends. Incorporations can be a very powerful tool, but it is not a magic bullet. So today we'll break it down by type of investor and the business goals that you have. So hopefully you can see where you fit in that.
How deep are we going tonight with this?
We'll scratch the surface.
Okay, yeah, because
that could be a presentation.
I'm sure that someone like I could see someone like go like this, like, okay, this is the one that I wanted to hear about. Should I be buying it in my personal name? Should I get it in a corporation? At what point should I start buying them in a corporation? Should I sell them from my personal into my corporation? How do I, appraise them? How do I do all this stuff? The financing, Keaton, how do they do the financing? We're going to scratch the surface today, but if they want to learn more about it afterwards, best way is to probably reach out to you, book a consultation, and find out, because like you said, it depends. It depends on each and every one of you guys. What works for Steve, what is different that works for me, that is different that works for Sir Harry, and everybody else, right?
And just because Richard Bell told me I'm not a lawyer, so
You're
the
not a
advice
lawyer.
I'm going to give you today will be from the financing perspective.
That's a great point. That's a great point.
So here I have a table that compares a sole proprietor, or let's call it owning things in your personal name, to a corporation. For investors who have active income, and what is active income? That would be your flips, wholesaling, and short-term rentals. If you incorporate, it could be a great way to access the lower, about 12% small business tax rate. But for those that hold long-term rentals, it is quite different. CRA would call your long-term rental passive income, and it would put it in a category similar to royalties, capital gains, interest income, and you will be taxed at nearly 50%, 50. I call that the penalty tax rate.
That's the highest tax rate in Canada too, isn't it?
That's the highest personal
Technically?
tax rate. It's 53%, highest
Yeah,
personal
it's-
tax rate. So basically, they don't want you to keep that investment money inside of the corporation. And one more thing they're going to do is they're going to offer you 30% refund of that 50% when you issue dividends to yourself. So at that point, why are we really setting up a corporation if we're still going to be passing through everything right back to your personal name? There are some signs when it would be a good time to talk about an incorporation. Maybe you're earning over $80,000 in net income and you don't really need to draw any of that money. You want to keep reinvesting it. You are doing active income, active deals, your flips, your short-term rentals, your wholesaling.
Is it safe to say that generally speaking, most people, if you're doing like a lot of like fix and flips and like active income, it makes a lot more sense strategically to keep it in a corporation?
Usually, yes.
Yeah.
If, for example, you have no day job and your flips only make you 50 grand a year and you're going to draw that 50 grand anyway, why really go through the hassle of paying for two tax returns,
Yeah.
having separate bookkeeping for one and the other and all that?
And then
right?
paying
But
12.2% in your
Exactly.
corp and then paying personal income tax as soon as you pull it out. Doesn't make any
Yes.
sense, right? But if you're making significantly more than that, let's say you're bringing in $300,000 a year and you're only paying yourself $50,000, and you want to keep that money in your corporation, continue to keep reinvesting it, doing more and more fix and flips, then yeah, it makes sense.
Exactly.
Right?
Some clients want to set up a corporation for the liability protection. That would be liability protection perhaps from your tenants, from your trades, or maybe your partners. Or maybe you have a joint venture partner that would only feel comfortable in a corporation. And in that situation, you accept the cost for it, and it's much better to have a deal than not have a deal. Maybe you just want to separate your personal finances from your business finances. That could be a good reason why you want to spend that extra money and have that corporation going. Or maybe it's come time where the bank would demand that they would only fund the deal if you set up a corporation, which is often what happens with commercial deals, like our MLI Select examples. Of course, if the bank says we'll fund the deal, but it has to be in a corporation, guess what? We're setting up a corporation, and then we're going to figure out the tax after. So again, much better to have a deal than not have a deal.
Yeah. Commercial lenders, they're going to want to see it in a corporation as well. So even if maybe you talk to Keaton and Keaton says, hey, you're capped out, you've gotten all the mortgages you can get. And I'm sure Keaton, I don't know where he is, but he's probably going to say, no, I can get you another mortgage.
Usually
but-
what we see is around 7 properties in your personal name. It's where you would start getting some pushback from the lenders.
Pushback
Yeah.
becomes a little bit more difficult,
Yeah.
and then you might start considering maybe going with commercial financing, getting a residential commercial financing. And in that case, you would need a corporation for that,
Yep.
right? So that's how I buy my properties. I buy them through a commercial lender, and I have them through my corporation. Do I want to pay 50, how many percent? 53%? Actually,
Probably not.
no, I don't want to, right? I certainly don't, but you do what you gotta do, you know, as you grow your portfolio, and it's better to pay that tax rate than to not buy any properties at all, so you do what you gotta do.
Essentially, if you're just getting started with 1 or 2 rentals, incorporating is often an overkill. But once your operation starts to look and feel a lot more like a business, you are doing this day in and day out, you're doing many flips, like you are actually going through the steps of buying and selling regularly, that's when it makes sense to have a conversation and see, is it worth it for me to set it up? And remember, you don't have to incorporate everything. Many investors use a hybrid setup. Some personal properties, and eventually some in the corporation as well. I have a few common mistakes that I see. Repeating myself a little bit, but incorporating too early. It leads to high administration costs. It's more complex, and it has unnecessary tax filings. We need to have a personal tax filing as well as a corporate tax filing. The corporation needs to have bookkeeping done for it. When we file with CIRA, we need an income statement and a balance sheet. Then we need to figure out how do we get that money out. So it just creates all those unnecessary steps. Number 2 would be putting rental properties in a corporation without a plan. What are we going to do with that 50% tax rate? How can we reduce it? Are we going to flow all the money through and claim the refund? When are we going to do that? Because what happens if we don't do it on time would be you've given CRA already 50% of your money, and then on the personal side, we're going to have that dividend that you need to pay personal taxes on, so you'll be out of cash probably, what, 75% or something,
Yep.
waiting for the money, for the refund from CRA to come back. So timing is very crucial. Understanding what your plan and strategy is needs to be figured out ahead of time. Sometimes we could do things like paying you payroll through your corporation, and we just need to discuss, does that make sense? And if it does, we would do that. And lastly, not having a clear exit or succession plan. The corporation will affect how you can transfer that property or how do you sell it to others. So making sure you understand how that works is super important. And lastly, do not do it commingling your funds. In a corporation, we need to have separate accounts, separate credit cards, and clean books. It's not your personal fund. It is a separate entity, and it should be run independently. So this is why working with a professional that understands all of these and explains them to you along the way is very important. Tax strategies. This is the fun part. How to legally keep more money in your pocket. As a real estate investor, tax strategy isn't something that you would deal just at filing time. The best investors build their strategy into every transaction, every renovation, and every refinance. The goal here isn't just to save tax, it is to stay audit ready and build wealth more efficiently. Top on my list would be deductions. You need to understand everything that is available to you and take advantage of it. Bring down that net operating income wherever you can. There are dozens of deductions, but there are some that most investors miss or underutilize. First one would be interest, and that is not just interest on your mortgage, but it would be interest on your lines of credit, on your credit cards, anything that is tied to that property and you need to pay interest on, we could potentially deduct for you. Once again, repairs and maintenance, as long as they are not improving the property's value or extending its life, it is something that we can deduct for you on an annual basis. And I have a question for the room. If I'm renovating a property and there is currently carpet in it. And that carpet is very nasty and it needs to be replaced. But as an investor, you decide, I will replace it with LVP. So now we're moving from carpet to LVP. If the carpet costs you $3,000 and the LVP costs you $5,000, what can we do? Is that a capital expense or is that a current expense?
Would it just be the $2,000 difference that's capital? Or is
Correct.
the whole $5,000 capital because you changed?
We're forward.
No,
In my opinion, if the old one was nasty, it's a current annual expense. If the old one was nasty.
Yeah, but that's only if you replace it with carpet, regardless of the price of the carpet.
That's right. So if you're replacing carpet for carpet and you're bringing it back to its original value, that would be a current expense. If you're replacing it from carpet to LVP and you're upgrading it, a lot of accountants who are busy and they're trying to do 500 people's tax returns in 45 days or something like that, they're probably going to say, oh, the whole thing, $5,000, CapEx. We're not going to claim it. But if you have the time and you're dealing with it throughout the year, you can make the calculation. That's an easy example, 3,000 compared to 5,000. But it's not the real number. So you will make the calculation, you'll have a work paper, you're going to save it in the client file, and you're going to maximize their deduction. So you're going to be able to claim that 3,000 in the year. That's $3,000 more that you're able to deduct when previously you couldn't. The difference is the only thing we're going to capitalize. And this is why I said earlier that in the beginning, spreadsheets are okay. But later on, when your portfolio is growing, keeping track of all these little numbers and how they add and subtract from each other, it becomes a nightmare. So having a professional deal with it can really go a long way.
And the other thing was, it's a capital expense or something that will increase the lifetime of the property as well? Is that what you said?
Generally something that didn't exist there and you're adding it, or it's something that is it's an improvement. So another example would be there is no basement suite and you're adding that basement suite, that all of the expenses associated to that would be an improvement. We're almost done. Property management fees. That could include paying your spouse or your kids if they're actually doing the work. So it is possible if you structure it properly. So make sure you understand what things CRA doesn't like to see, and that would be just making it up. But if it is something where you get your kids to mow the lawns for all your rentals or something like that, you could potentially pay them. And they would be able to take that money essentially tax-free and perhaps use it for their education fund.
Is there a minimum age? I
I
have a
want to say
10-year-old daughter.
14 or
Yeah, put her to
16,
work.
something like that. I think
Is
at
there
12,
actually a minimum age?
there is. I
Yeah.
believe at 12 you can do it with parental consent, and then 14 where you can. Every province is a little different, so we'll have to look that up.
Yeah.
Office and administration. So that would include your cell phone bill, your internet, and a portion of your home office. Some of you might be working out from your kitchen table, and that's okay. We can actually still calculate and prorate that. We're going to look at how many hours do you spend on that kitchen table for business, for your rental, and how many hours do you spend for other uses, and we'll take a ratio for it. Some people feel like it's not necessary to go through that exercise because it's difficult to calculate. If we do it once, we can keep repeating that over and over again. The key is having the backups of how did we determine what that ratio is. Once we have it figured out, then the rest is easy.
Can I ask a question about this? So you would estimate square footage of, let's say, home office as a proportion of the home, right?
Yes?
And what expenses are we talking about? Like mortgage interest on your principal residence?
So the question was, once you figure out the square footage of your office compared to the square footage of the entire home, that would be one of the calculations. The second one would be the time. How long do you spend there? Because if you only spend 2 hours a month for your rentals, we need to discount for that as well. And then the question was what type of expenses that would be all of the operating expenses of your property: mortgage interest, insurance, property taxes, utilities, etc.
CRA is not here, but they'll probably see this on YouTube. But realistically, are we really like clocking every single minute we're sitting at the desk in the house, or are we just like, are we roughing it?
No, it would be a rough estimate, but it needs to have some type of calculation that we can do for it. So how long do we really spend there? I have many questions. I have two more
I was going to
questions.
say specifically
Yeah.
because you don't. This is all prevention in the event that you ever get audited by CRA, correct?
Correct.
This is like
The number is not very big,
extra.
but it is something that could go a long way. Can we maybe hold the questions, and I'll finish with 3 more points, and then we'll go to questions.
Oh, wow,
How about
yeah.
that?
As soon as you said office
Yes.
and admin and deductions,
I just have
there
a
was
couple
like-
more.
That's good.
Travel and mileage, driving to check on the properties, meeting contractors, attending real estate events like today. You probably also had parking in addition to that. Trackers would be QuickBooks Online. There is a built-in tracker to it, which is pretty awesome. If you're already paying for an accounting software subscription, might as well take advantage of it. Dex has come out with a mileage tracker as well, which is pretty fun. So even if you don't have a proper accounting software, you only are using spreadsheets, you could have Dex. And my new favorite one is called Mile IQ. And it's actually free for up to 40 trips per month. So that means if I drive from home to Home Depot, from Home Depot to the rental, from the rental to the other rental, and from that back home, that would be 4 trips, I imagine. That's how they count it. But you could do up to 40 of those a month, and it costs you nothing. And it gives you a very clean report of where you've been and what you can do. And then lastly would be all of your professional services, your legal, your accounting, your bookkeeping, and any consulting you do. So if for whatever reason you want to spend 2 hours with me working on your file and there is a fee associated with that, that would be a deduction that you need to take care of. And remember, a $12 parking receipt might not matter now, but during an audit, that could become $120 when we add it with a whole bunch of other little receipts. Okay?
Side note, was I the only one that paid for parking out here? Did everybody else park across the street? I went to go get like a piece of gum, and I looked and I was the only one in the paid parking. But I kept my receipt.
That's good. Now, I'm going to touch on a few more advanced strategies, and I'm sure many of you will have questions on that after, and we'll definitely go over that. Capital gains. I think that died again. Capital gains.
I knew it was here for a
That is
reason.
basically when you sell a property after that you've held for some time, whatever the difference is of what you sold it for and what you bought it for, minus realtor fees and closing costs and whatever rentals you did, all your capex essentially, half of that money is tax-free. You just get to keep it. The other half gets added to your income no matter what other income you've made. So maybe you have a salary of $100,000 and then you have $50,000 of capital gains, that would stack on top of it. So sometimes it could be a little bit expensive.
Can we give like an example, or is there no time for it? You bought it for $400,000. You sold it for $500,000. It's $100,000. Never mind.
$100,000 in capital gains in his example. From the $100,000, we would minus the realtor fees. Let's call it 20 grand. So 80,000 left.
Yep.
From the 80,000, we're going to minus out any rentals you did. Let's say you did 10 grand of painting and something. So that would be 70,000 left.
Yep.
We'll half it. Half of that money you just get to keep. The other half we will add to your taxable income.
And then if you're in a 40% tax bracket, they're going to make you do that math.
Whatever that
How much
works
in
out
taxes
to.
are you going to pay? Somebody want to do that math? Calculate it real fast. 35,000. What's that? 20? Is it even? Yeah? Wow.
Yep.
That's really good.
Well, yeah, 'cause
Maybe ish, something like that.
40% times 50.
The number doesn't matter. Let's
But the
just,
point is
let's-
that on
it could
$100,000,
be a
you're-
big number.
Yeah.
That's the important
Yeah.
part. Now, I want to give a warning for everyone. I have been hearing about this new flip tax or flipping rule. It's not really a new rule or a flipping tax. All it really is that CRA has figured out that some people have bought properties, renovated them, and sold them less than a year, and they're trying to say that that was capital gains, when that's not really the case. So they just made a rule and they said, by default, if it happens that the sale is less than 12 months from when you bought it for, automatically that income would be considered business income. And that's why we say that flips are great in a corporation. They take advantage of that lower corporate tax rate for active businesses. So it's not really a new rule, it's existed there, it's just how it's administered. Now, there are exceptions. Maybe you bought a property and because you had to move closer to your job, but COVID happened or something and that job laid you off and you can no longer afford it and then you have to sell it and it's less than 12 months. There are unique exceptions to that, but it's not the rule. The rule is that by default, it's active business income, okay? Now, why are we talking about capital gains? Because we also have something called capital cost allowance, which essentially means depreciation of the building. This is something that a lot of investors feel very unsure about, and it's something that we would normally model for you and try and figure out, does it make sense or not? It is often not recommended if you're planning to sell in the short term, but it is very useful if you're holding the properties long term. And why is that the case? If we claim depreciation on your property, we're able to reduce your tax bill today. So if I can get you to pay $5,000 less this year, $5,000 less next year, and I can do that for the next 10 years, you have $50,000. What can you do with that $50,000? Could you take that money and invest it smartly and make more than that? Probably yes. But what will happen at the end, after 15 years or however many years you end up keeping that property for, all the money that you claimed as a depreciation, a CCA, would be added back in that last year. So we're not deleting the tax, but we're putting it in the future. I just hope that all of you know money in your pocket today is more valuable than money in your pocket 15 years from now. So if you could take advantage of it, do it, but it works for some people, and others feel like it's okay if they just pay their little bit of tax every year. We can model it, figure out what makes sense in your situation, and decide if we're going to implement it or not. It's a very optional thing. It's the only thing I can think of in taxes that is kind of optional.
Yeah, no, I was just gonna say, if you can get money now, and defer it, and be able to invest it. If you're planning on keeping that property for 20, 30 years, take the money
another
now,
rental.
invest it, buy another rental property, make money on it, and then just pay you can pay it back later, right? I can't believe you tried to do CCA in 2 minutes or less. I was actually quite surprised. But if you guys want to learn more about depreciating your asset
CCA is a presentation on its own.
Yeah, it's a 1 hour presentation, but it's really cool. When I first learned about it, it's pretty awesome.
And the last thing I'm going to cover, that would be your principal residence exemption.
Mm-hmm.
If you lived in a property, even for part of it, let's say it's a duplex and you live in half and then the other half you have tenants and all that, you may be able to shelter some of your gains from capital gain tax. Be cautious. If you're flipping a principal residence every year, CRA is watching you. They actually have a website, like a sub-website on their page. What are we doing to catch real estate fraud and stuff? And they have graphs showing how many $1 million they've recovered from targeting real estate specifically. So if anybody's interested, definitely go and check it out. But the big reminder that I have for you is when you have a primary residence that you've lived in for a number of years and now you're buying a new one and you feel like you want to just move and convert the original primary residence to a rental, that is something CRA calls a deemed disposition. So it is as if you sold it. And it means we need to file and claim that exemption for you that year, the year you moved out, even though you haven't physically sold that property. It would be kind of similar if you do it the other way around. You have a rental that has been a rental for 10 years and you're moving back into it. If you move back into it, that is a deemed disposition. So all it means is that now all these capital gains are technically due. We do have options for us. We do have elections that we can file. We can extend and get you to not pay it until you physically sell the property. But you need to understand that some of these elections require a paper tax return. So we need to plan around the mailing, the processing, all that kind of fun stuff. So principal residence exemption is available, but be mindful of change of use. Those are quite important, and a lot of my clients realize that, oh, I did change use, but I never filed anything. That's a missed opportunity for you. And now I think we should take some questions because I think there is a lot in the room.
So I'll just say, because we only have one microphone.
Yes.
If you can get them to question for our
Sure.
online guests?
Yes.
Or, sorry,
I can repeat the
sorry,
question.
you repeat the question
I will
for
repeat
our
the
online
question.
He was doing that by himself without
Yeah.
me
He's doing
saying
a good job.
anything.
Yeah.
Just to make sure.
Thank you.
Thank you.
Veteran.
Go ahead.
I have a couple questions. The first one is, when you're doing this disposition, change of use for your principal residence tax exemption, would it make sense for people to acquire a
Appraisal?
yes, that's the word I'm looking for,
So the question is,
to
yeah,
basically protect the portion of your property that
Exactly.
you can still claim for your principal tax exemption.
we want to make it as big as possible. So basically the question is, when there is a change of use from principal residence to a rental, and we are claiming that capital gains exemption, what we want to do is get a realtor CMA or an appraisal or a property tax bill or anything that shows us the value of that property as high as possible, because it will be exempt. And then we're locking in, and that's our starting point, or ACB, adjusted cost base, for when we're calculating how much capital gains you need to pay in the future. And yes, go ahead with your second
Sorry,
question.
Second question, sorry.
No, mine's just.
Is if you're taking advantage of using a portion of your property that you're living in as an office, and you're gonna take, let's just say 10%,
Mhm.
how does that affect your ability to claim the entire amount of your house, protecting the capital gains
Okay.
exemption?
So
Is there a clawback?
Yeah, the question is, if you're using 10% of your property as an office space, how can you protect it from principal residence exemption? And the answer is, in a principal residence exemption, the rule says you should not be using a significant portion of your property for business or commercial use. So it really lies in what is the definition of significant. Many people are taking different positions at it. At my firm, we go up to 40, maybe 45% of the property, because that would be a basement suite. So if if the income you're earning is incidental, you have a basement suite that is 40% and the main floor is 60%, then the entire thing would be protected. If it was the other way around, where the client would live in the basement suite that is 40% and rent the main floor, we would then discount the exemption at that 40% rate.
Great question. Great question. Saw some more hands.
Other questions? Adrian?
Is there any way to make long-term rentals an active business?
Is there any way to make long-term rentals active business? If you grow your portfolio inside a corporation to be significant enough where you need to hire 5 full-time staff members and it acts a lot more like a business, it may be an argument that it's now transitioned into an active business compared to passive. But that would require a quite significant capital investment, and you'll need to have a lot of properties for that to, afford the 5 full staff members.
He's going to get audited too, isn't he?
It's okay to be audited as long as you have a filing position and you have documentation to support what you're claiming. Well, that's what we call it, a filing position.
And as Wayne said, you can hire all your 10 kids, right?
Well, you can hire all your 10 kids, but I'm pretty sure actually the rule says it cannot be family members. They need to be all independent and they need to have like market wages. And there is a bunch of like rules around it. You can't just do like, oh, here's full-time work, but it's like $25,000 a year or something.
Right. Right.
Hold on, did you say you cannot hire your kids to help you with maintenance?
No,
In this circumstance.
it is for the situation where we want to convert a corporation that is passive in nature to active. So like it's a pretty specific case. Yes, go ahead. Next. Somebody else? Yes.
Ed.
If you want to start maybe converting some of your rental properties and moving into like a family trust to kind of think about inheritance to your kids, and then is it considered deemed disposition at that point?
So the question is, if you're moving some of your properties to a family trust, is it considered a deemed disposition? It can be. It would be important to really plan the inheritance. Actually, at Finngo, I don't specialize at inheritance planning. We don't do that as a firm, but we can outsource it to someone that can help you with it. Once it's set up, we can help with the filings that are ongoing, but the actual creation of the plan, it needs to be someone that has a lot of experience around it, and there's many questions. And family trust can only last, I think, 21 years or something like that, so you really need to plan when is the right time to do it. You don't want to do it too early.
Yeah. Great point, and great question.
2 more questions.
All right, pick the best 2.
Trina?
Trina, do you remember?
Yeah, I do. So 2 questions. So about the deemed disposition, that can, like, because what I did in the past, so I don't know if this would still work, but we moved out of a property in, I forget what year. Anyways, like a decade ago, and then we had like a CMA from a realtor, and then we used that as the deemed disposition. But so like now, if I did that strategy again, would I need to report that in the year that I move out of it? Because I don't think we did that. We just had the CMA, and then when we sold it, 5 years later, after having rented it as a rental for 5 years, then we used the original CMA.
Great question. So the question is, she moved out of the primary residence, got a CMA, but did not put it on the tax return. It would kind of depend on which year it was. There were a few years where CRA didn't have the requirement to claim the principal residence exemption on it. However, that changed, and we need to be whenever it occurs, we need to be claiming it. So if it was like 15 years ago or 10 years ago, maybe not, but if it was in the last 5 to 6 years, then yes, it should have gone on your tax return.
Because they make you claim
They make
what
you
your
report it.
principal residence
Yeah.
is now on your taxes.
And it's like separate signatures, and everything is completely separate because they're tracking it. Prior to that, they were not tracking it. Yeah.
So now I have a further question to Adrian's question about the long-term rental, because a short-term rental is active business,
Mhm.
right? So then it's like, yeah. I'm just wondering, because we got stuck with that in our corporation, where it was just like, you're working hard at it, and they're trying to pretend it's passive, and it gets frustrating.
The
for
long-term,
the long-term
yeah,
rental,
the
right? So I'm
the
just
long-term
wondering-
ones would be pretty clear-cut. The short-term, even CRA recently, like you probably heard about all of the GST issues. If you're selling your Airbnb, you have to pay GST on the building or the property. That's because it is considered commercial activity, therefore it's business. So even CRA has said that it is a business income. It actually helps the case of keeping the Airbnbs in the corp and paying the lower corporate tax rate.
Yeah, that's my questions around that, yeah.
What was that last question? James, you taking it?
I just wanted to ask about depreciation. So I was listening to this American podcast.
Oh,
Are we
stop
similar-
right there.
are we similar-
Just stop right there.
Are we similar to their system in terms of depreciation for things that we buy for tenant use, appliances?
I have no idea. I don't know any American tax, so I cannot.
Are we in Canada?
Yeah.
Do we have depreciation? For
We
different
we
items,
do,
different schedules
yes,
for different
we do
items?
have depreciation. It's just called capital cost allowance. It's the tax term for depreciation.
What would you recommend an easy guide to understand this process?
Book a call. I think you would need to understand, like it takes some time to understand it if it makes sense or not for you. There are things around recapture that are a little complex to explain, but it is something, it's a tool that's available to us. And often it's a very good tool that we can take advantage of.
Yeah.
Awesome. Thank you so much, everyone.
Yeah, thanks so much, everyone. Appreciate it.
See you later. Thank you, guys.